What's up, guys? Welcome to another investing video, and in this video I'm going to talk about a rather trivial question. I'm not selling it very well, but I think it is worth talking about. Obviously, that's why I'm making a video about it, and that is, why does the share market actually exist? I know people are keen, get in there, they want to start making money, but whenever you look at something new, there's always two questions, which is, well, what's new and so what? And they get caught up in the what's new, but they forget about the well, so what? And that's actually more important. So why does the share market actually exist? Well, there's two main concepts that we have to understand, which are the concepts of debt and equity. Now, hopefully you've heard of these terms, even though you may not understand exactly what they are. But a couple of simple examples of debt are things like a bank loan, or a bond is another example. So with debt, so let's actually look at an example. So let's say that you run a pizza shop and it's going pretty well. You've built up a customer base, you're making money, and you decide that you're going to open a second shop. However, this might cost you, for argument's sake, $30,000 because you have to buy the cooking equipment, and there's marketing costs, advertising costs. You got to deck out the new shop, etc., etc. So you could actually go to the bank and borrow $30,000. Now, using debt, there is one, and I'm sort of simplifying things a little bit, but there's one main advantage and there's one disadvantage, one major disadvantage. So the major advantage is that you keep your ownership. Okay, so if you borrow money to open this new pizza shop, you still own that pizza shop. The disadvantage is that you must repay. If you don't repay that loan, or you default on that loan, then the bank has a right to repossess your business or whatever you use as collateral to secure that loan. So a common example is when people buy a house, that will be secured by the property itself. So if you default on your loan, then the bank will repossess your house. Okay, so you absolutely must repay the loan. Therefore, you have a lot of the risk. Okay, so you have that risk. So debt is actually, it's fairly low on risk and it's fairly low on return. So the bank might charge, as of the time of this video, interest rates are very low, but they will just sort of, because the market is, that's another story I won't go into. But you might earn 2, 3, 4%, or the bank might earn 2 or 3, 4%. So that's a fairly low return, and that's because it's relatively low risk. If you default on your loan, the bank can just repossess your house or your business, and they can recuperate their money. Now let's talk about equity. Now, a couple of examples for equity is the share market. Now we're talking, aren't we? And a second example, and there are lots of examples, and you may laugh at this terminology, but angel investors. Okay. So angel investors are basically they're sort of rich individuals or people looking to deploy money, and they will buy stakes in businesses. Now, as you may have guessed, the advantage and disadvantages for debt are actually swapped. So the disadvantage for equity is that you have a reduction in your ownership, and the advantage for equity is that you actually have you don't need to repay. So there's no obligation. In fact, there's actually no need to repay. So let's go back to our pizza example. So you need $30,000. Now, if you, for argument's sake, let's say you go to good old Uncle Freddie and you say, Uncle Fred, I need $30,000 to open my new pizza shop. And Uncle Freddie, being the kind soul he is, might say, yeah, okay, I can provide $30,000, but I want to actually have a stake in your business. So let's just say, for argument's sake, that he's willing to put $30,000 for a 30%, I'm just keeping the number simple, 30% stake in your business. Now, this is not a loan, okay? It's actually a financial transaction. You've actually sold a part of your business for a price that you have both agreed on. So you actually never have to repay Uncle Freddie. That money is yours. That $30,000 is yours, okay? However, the 30% of your business is now Uncle Freddie's. So if the business actually goes badly, then that's also Uncle Freddie's problem, because he owns part of that business. So with equity, I mean, for you, in our example of the pizza shop, you actually have less risk. But for the investor, they do have risk, okay? Because now Uncle Freddie, he gets nothing for his $30,000, right? There's no immediate return for that $30,000. So he's really betting on the business doing really well. He's betting on this new store doing well and making money, because now he owns 30% of the business. So therefore, he gets 30% of the ownership, right? So that's kind of, and then, yeah, as I said, with the ownership, so for you as the pizza shop owner now, you don't own 100% of your business, you only own 70% of the business. So if it goes really well and the business is doing really well, now you only get 70% of the profits instead of 100%, assuming that you were the sole owner before this. So I'll talk about this more in the next video, so make sure you check out that. But the purpose really is just to understand that when you buy shares on the share market, you are actually purchasing an equity stake in that business. You are actually becoming a part owner in that business. Now, it might be only a very, 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 very small fraction. You might only own $1,000 of shares on a business that's worth, $50 billion or $100 billion, but legally you still have ownership of that business. And equity in general is higher risk and higher return. And so you would hope that when you're investing money in the share market, you're going to earn a high return. And that's probably why you're watching this video and looking to invest in the share market, because when you put your money in the bank, that's actually kind of like a loan to the bank. That's why the bank pays you an interest rate, but it's a very low risk, very low return. So that's why people go into the share market, buy stakes in businesses, because they want to earn a higher return. But like anything in finance, there's a price for that, and that price is the risk that you get and you want to be compensated for that, obviously. And so one thing I didn't actually talk about as well is that, going back to our pizza shop example, Uncle Freddie now owns a stake in the business, so he actually is a part manager of the business. So now you can't just make any decision that you want. Now Uncle Freddie, as a part owner, he has a say in what you do. So for example, you might say, I want to now have twice the number of different types of pizzas that we offer. Well, there's risk in that. You have to, pay to get the menus redone or the signage redone. Your stock management is now going to be more difficult because you have different ingredients, etc., etc. But Uncle Freddie may not like that. He might say, you know what we're doing, it's working. Let's keep it simple. Let's keep it more cost effective, etc., etc. And so you might disagree on these things. And it's the same when you buy shares. You actually can vote on who gets elected on the board. You can attend the annual general meeting, etc., etc. And you can only vote in proportion to your stake. So it may not be meaningful, but you still are a owner of that business. So I'm going to explain a little bit more about equity in the share market in the next video. So make sure you check that out.